How do you balance a retirement income that lasts as long as you do and still allows you to spend so you can enjoy retirement? Well, Vanguard's published a withdrawal method that I think is flying under the radar. Today, I'll compare the Vanguard method to 3 other retirement income withdrawal strategies, ranging from the traditional but outdated 4% rule to an adaptive, dynamic approach to paying yourself. And while I really like the Vanguard method, it's not my top favorite. I'll finish with an even better strategy created with new research and technology. And the good news is you are ahead of the game. Most retirees have no strategy at all when it comes to retirement income. In all 4 methods we'll look at today, you'll find takeaways that you can apply to what works best for you. So let's dive in. The most famous retirement withdrawal method is the simple 4% rule. Bill Bangan's research in the 1990s paved the way for a more thoughtful way of withdrawing money from your investments. As it sounds, you can withdraw 4% of your portfolio value. So if you have $1 million, you can withdraw $40,000 per year and then increase that $40,000 each year by the rate of inflation. So based on a portfolio of 50% stock and 50% bonds, Bangan found the portfolio should last most 30-year retirement timeframes, even with the expected ups and downs of the market. It's simple, it's straightforward, it's also static and outdated. As you might expect, different points in history could cause the outcomes to be wildly different, which in fairness is the objective of the 4% withdrawal rule. It's to guard against the worst case scenarios or at least get close. As you can see here, each line represents one of 1,000 different scenarios, starting with $1 million portfolio invested according to a moderate 60-40 allocation of stocks and bonds and $40,000 of income extending for 30 years. In 10% of scenarios, the $1 million actually ran out, the earliest occurrence in 23 years. But given that it's a conservative calculation, the other side presents a different kind of risk. In 53% of outcomes, the retiree ended up with more than $1 million. Now, while that may sound good, it can also be perceived as underspending. How many of those hypothetical households frugally scraped through retirement only to discover they could have spent much more? And the timing really does matter. Let's look at 2 opposite and extreme historical time periods. Retiring in 1966 turned out to be one of the worst times to retire, as the stock market had a rough run starting in 66 and then into the 1970s, when inflation also ravaged purchasing power. The story was much different, though, for someone retiring in 1986, as the stock market went on a major bull run, and that $1 million, even after paying income, would have increased to $3 million on a real basis. In Vanguard's guide, they summarize of the 4% rule. Although this strategy allows for more stable inflation-adjusted spending from year to year than the other spending strategies we discuss, it comes with the risks of premature portfolio depletion, misaligned inflation increases, or lifetime underconsumption. The uncertainty of when you retire, unfortunately, has a major effect on the outcome. The second traditional method, which I won't spend as much time on, is the percentage of portfolio method. And I need to show you this because Vanguard builds on it for their method, which we'll talk about next. Now, this method is as simple as it sounds. If you choose, for example, a 5% as your withdrawal rate, or even more conservatively, 3%, you apply that to the portfolio value each year to determine your income. Because it's based on a percentage, the positives are that the portfolio would never run out, and it's actually the easiest to implement. But to the negatives, Vanguard says the annual spending amount will fluctuate significantly, which is neither prudent nor realistic when considering the volatility of the capital markets, preferences for relatively consistent spending levels, unique non-discretionary spending needs. So what this means is this is a tough method to use if your investment withdrawals make up a significant portion of your overall income, unless you're extremely flexible for income reductions at times. Vanguard's method addresses these issues. So let's get to the advances that Vanguard's dynamic spending method makes by putting you in control of your initial withdrawal rate and providing guardrails, or what they call a ceiling and a floor, so you can adjust your spending but not overdo it or spend too little. Essentially, Vanguard's method seats itself nicely between the dollar plus inflation, which is really the 4% rule, and the percentage of portfolio rule. It adjusts to market performance and allows for some fluctuation in spending, but aims to smooth things out. So all this with a focus on not overspending or underspending. I mean, in short, it can adapt to the circumstances. So let's look at an example. And I will say that I've seen different interpretations of how to actually calculate this. I'm not sure why Vanguard doesn't provide a calculation example, but I'll show you what I understand to be correct after researching. Okay, let's say your portfolio is $1 million, and the first thing you want to do is establish three numbers. One is a starting withdrawal rate. Let's do something different than 4%. Let's go with 5%. After all, one of the benefits of using guardrails is that it should allow you to spend a bit more as long as you're willing to tighten the belt when it comes down to it. You could also choose a 3% withdrawal rate if you want to be conservative. And then we have a ceiling, and this is the max your income will be in a given year. Vanguard uses 5%, so we'll go ahead and use that. And then you have a floor. We'll use negative 2.5%. This is the max your income will decrease in any given year. You get to pick those numbers, but Vanguard uses 5% and negative 2.5% because it results in a 85% probability of success. Okay, so let's figure out the income. That 5% on $1 million will result in $50,000 of income. And for simplicity, let's say you withdraw that all at once. Then your portfolio will be $950. And we'll say that you earn 10% for the year. So now you have $1,045,000 at year end, and we'll use that value multiplied by our withdrawal rate of 5%. So you get a preliminary income of $52,250. But we have to confirm to ensure that it's within the guardrails. And here's where it gets a tad tricky. So bear with me here, and I'll try to be concise. So what we do is we take last year's income of $50,000 and we multiply that by the rate of inflation, which we'll say is 3%, which comes out to $51,500. And then we have to get to our ceiling and multiply that by 5%, which is $54,075. And with our floor, we're reducing that by 2.5%, so we get to $50,212. Okay, now in the case of our preliminary income of $52,250, well, it fits within our range. So that's your income for year two. If hypothetically that preliminary income was higher than our ceiling, let's just say $55,000, then we would cap it at $54,075. Same thing if it ended up below, let's just say $45,000, it was a big reduction, well then you would not go down below the floor. So a few of you, if you're really nerdy about retirement withdrawals, may have noticed this traditional guardrail method is similar to the Guyton-Klinger guardrail system that was developed in 2006. It's not critical for you to understand the finer details, but what is important to understand are the similar limitations of these methods. The first thing is that this is not the easiest calculation. Once you get on track, you may be fine, but the primary setback I see is the expectation that withdrawals will be steady over retirement. We know that for most people, out of the ordinary needs will arise. In some cases, large expenses will be part of the plan, but common planning scenarios like deferring Social Security in order to maximize that income may require a higher portfolio withdrawal rate while you wait. We call this the retirement distribution hatchet. Or commonly, your mortgage will be paid off some 5 or 10 years into retirement. Well, these common scenarios can change your withdrawal needs. It's not always steady. And while the Vanguard method has its issues, it is adaptable and potentially easy to implement once you're on a course. But what if we could take the concepts of the guardrail system, but also account for large expenses, gaps in income, and other uneven scenarios which just happen to be a part of life? Well, there is a better way that can build off the foundation and the benefits of traditional guardrails to a more dynamic and responsive strategy. The risk-based guardrails approach relies on a financial plan's probability of success as determined through Monte Carlo simulation. It can even allow for life's uneven spending, and this is where the benefit gets really big. This improves on Vanguard and not require as severe income reductions as Guyton or the percentage of portfolio methods when the investment markets are floundering. Now I know, while one more withdrawal method may seem like a distraction, you might be surprised to learn how much is at stake. Okay, so let me show you the plan of John and Mary using Income Lab. They retired at 60, which is early, and they need their money to last. So what we can see here is from the $2 million portfolio that they have, they can spend $10,500 per month. And if you're quick with math, you'll figure that's a 6.3% withdrawal rate. In just a minute, I'll show you why that's the case. You'll also see their guardrails here. If their portfolio increases to $2,139,000, they can give themselves a raise of $800. If, however, their portfolio decreases to just under 1.5 million, and this can be due to investment declines plus their withdrawals, they need to tighten the belt by $510. The great thing about this is they don't have to guess when to tighten the belt in those rough economic times. Their plan will guide them. Now, why are they taking a 6.3% withdrawal rate? It seems high. Well, in their case, they still have another 7 years until they plan to start Social Security. They have this common hatchet shape where the portfolio withdrawals are higher during that gap, but will decrease once Social Security starts. That does put a bit more pressure on the portfolio initially, but that's why we have guardrails in place. And it allows time to get the Social Security to a higher amount that will then last the rest of their lives. This is just one example of uneven cash flows and why the risk-based guardrails approach is more dynamic. Now, we're also projecting their cash flows based on this retirement smile, which you can see here. This mimics the common spending pattern of retirees who tend to spend more initially in those go-go years, perhaps through travel, and then less in the slow-go years, and then it tends to edge back up during the no-go years as healthcare can get expensive. Now, the good news is this system is flexible. Some of our clients prefer a flat cash flow path as they'd rather not presume upon the smile, and that's perfectly fine. Now, what about the downside? Because the risk-based approach tends not to reduce income as much as guidance. Vanguard's floor does help, but it's not as adaptive in my opinion. Well, according to Kitces.com, when comparing the risk-based guardrails to the Guyton traditional guardrail system, it says, those retiring just before the global financial crisis would have seen a 3% reduction from the initial withdrawal rate using risk-based guardrails compared to 28% for the classic Guyton guardrails approach, and those retiring before the stagflation era would have experienced a still painful 32% reduction compared to 54% for the original approach. And even those reductions could be less if you initially set up more conservatively, as I'll show you with John and Mary. By the way, I'll post a link to that Kitces article that compares the method's downsides in the description if you want to dive deeper into the research. Okay, so let's go back to John and Mary's plan, and let's do that historical test. Let's go for the stagflation era with the bad stock market and the double whammy of high inflation. How did it affect their income? And I do strongly suggest not getting too caught up in the numbers I'm going to show you. Remember, the beauty of this, it can be uniquely designed based on timing, assets, income needs, longevity, tax ramifications. All these things can be unique to you. Now, in their case, their income would have held up relatively well, even getting a bump early. Then in the early 1980s, that pressure on the portfolio would have brought them down a little bit. They would have had to tighten the belt. And you could see here the guardrails in action. Now let's go back up to the income projection, and I'm showing you this on a real basis after inflation. When the heavy blue line is above the green line, that means they can actually spend more than originally planned. But you don't need to withdraw that. You can leave that invested or put it in the bank if you don't need it and minimize reductions later. But again, the guardrails are in place so you can enjoy your retirement money and have a plan when things that are out of your control go south. So which method is right for you? I'd propose that the risk-based guardrails, which has had the advantage of building on the other methods with research and technology, is the most complete. And for your retirement, that's important. If you want to talk to one of the CFPs on my team about managing the risk-based guardrails for your retirement and incorporating the proper asset allocation and tax plan, you can find a link in the description down below. And if you're in the home stretch to retirement, you're in the most important time for planning with the opportunity to work towards even doubling your nest egg. You need to watch a recent video I posted. Here's why the 5 years before retirement are so important, which you can watch here or in the description down below. Thanks for watching.